Okay, thanks everybody for joining us today. So what we're going to do is we're going to talk about really our investment and investment portfolio philosophy at TNT Capital Management. And it's the idea of learning to treat your investment portfolio as a business. And I think it's one of the things that separates us from most other advisors out there. So let's go ahead and get started. Firstly, of course, there's risk in all investing. Options aren't suitable for everyone, and past performance is not indicative of future results. So what we want to do is we want to look at your overall balance sheet. Okay, so what assets do you own? What do you have? A house, multiple houses, your car? Do you have a 401k or a pension, IRAs, bank accounts? Cash investment accounts, other real estate? Do you own a business? Do you have life insurance? That sort of thing. So we need to really get a clear picture of everything that you're working with there, and what are the value of those assets. And then, are those assets being maximized for both utilization and risk-adjusted returns? For instance, if you own a rental house in Palm Springs, or excuse me, a vacation house in Palm Springs, are you renting it out when you're not staying there? Maybe you don't have to. Maybe you can afford not to do that. And that you just like knowing that no one else is ever staying there. But those are the things that when we kind of develop a financial strategy for you, that we're going to want to be discussing. Next, we look at the liabilities. So how much debt do you have? And importantly, what types of debt are we talking about? A mortgage is very different than credit card debt or student loans or medical debt. Do you have a home equity line of credit? How is that debt structured? Is it long-term, fixed rate, adjustable rate? Are there balloon payments or interest only? And then debt prioritization. Which debt should be paid off first? Can we consolidate debt? Is it worth negotiating with lenders? These are key aspects where we've been able to add a lot of value for our clients, and just in our own lives too. It's imperative to really get rid of that credit card debt. Don't run balances if it possibly can be avoided. Some people view mortgage debt as a problem. They want to pay off their home and just think of themselves as debt free. But there also are costs and negatives to doing that. So those are the types of things we talk about. Then we look at equity. So, assets minus liabilities equals equity. What is your overall net worth? And how can we maximize the risk-adjusted growth of your net worth? So that's really what we're trying to do. We want to get the best risk-adjusted return on your assets, structure your liabilities in as favorable a way as possible. And then kind of future goals, is distributing your equity to children or charities a priority, or are you just looking to kind of maximize consumption over your lifetime? So those are all critical elements to really understanding your balance sheet. Now we're going to look at kind of your income and cash flows. So what's your annual income from work? Do you expect that work income to grow? And if so, by how much? What we also look at here is how stable do you view your income? Is it a job that you've had for 15 years and that, is in an industry that is protected to some extent? Or is it something that, the turnover can be quite high? So those are key elements in kind of, placing odds at how stable that income is. What other sources of income? So is there Social Security, investment income? Do you have a side gig? Maybe you're driving for Uber or selling cakes, out of your house, whatever. Do you have an annuity, perhaps that you can annuitize down the road, or pension distributions? And so what's your after-tax free cash flow per year? Critical questions, and it's important to kind of have an understanding of these facts. And are you maximizing the tax efficiency of your various sources of income and expenses? So, some people, just focus on various investments, stocks, bonds. Maybe there's better opportunity for them if they're in a high tax rate in municipal bonds, for instance, especially with rates having gone up quite a bit. There's some decent yields there. And if you're in a high tax state like I am in California, or if you live in New York, municipal bonds can be a powerful tool to lowering your after-tax income. So this is a great quote from the founder of value investing, Warren Buffett's mentor, Benjamin Graham, and he said, "The individual investor should act consistently as an investor and not as a speculator. This means that he should be able to justify every purchase he makes and each price he pays by impersonal, objective reasoning that satisfies that he's getting more than his money's worth for his purchase." So when I read this quote many, many years ago, several decades ago now, it struck a chord with me, because if you really apply it to your day-to-day life and your financial responsibilities and your financial strategies, it can really pay fantastic dividends, literally. I mean, if you're really thinking about, like, okay, how do we optimize the liability structure of our financials? So I mean, if I could get a really low rate mortgage, for instance, or a low rate home equity line of credit, and consolidate very expensive credit card debt onto that, that's going to save me a lot of money. Conversely, a fixed rate, low rate mortgage is a tremendous asset, really, because I mean people were able to lock in very low rates, 3%, 2.5%, and I mean you can invest in treasuries, for far more than that now. And so those are the things that we want to look at. So we want to look at that from how we invest, how we spend, just how we look at things from a financial perspective. So Benjamin Graham, he created really a value investment framework, and it's a way of looking at securities. So every stock is simply a fractional share of a business. Every business or stock has an intrinsic value. Over time, the intrinsic value of a business and the stock market value of a business converge. The timing is tough to predict, so it could be 3 months, it could take 3 years, but over time, the disconnect between price and value, it should converge. And by buying that business at a substantial discount to intrinsic value, you are thereby creating an adequate margin of safety. So if you think a stock is worth 100 and you're buying it at 50, well, if you're right, you have a great opportunity to double your money. B, if you're wrong, and let's say that stock's only worth 75, and you're still making money, and you're definitely not losing money in that example. So that's what Graham meant by margin of safety, and that's one of the things that we look for. So determinants of intrinsic value, how do you value a company or a security? Well, there's discounted cash flow analysis. So I mean that requires projections into the future of what you think the growth rates will be, what the cost of capital is. So that's one way to do it. You could do valuation based on normalized earnings power. So if you think, so-and-so's company over a 10-year period, they should average $4 per share of earnings. And if the stock's trading at 20 and you think it should trade at 10 times earnings, well, that would imply a $40 stock price. So that's a valuation method. Valuation based on what a sophisticated private market buyer would pay to buy the whole company. So, you could look at acquisitions that go through, what is the implied valuation there, and then you look at companies in the same industry, and if they're trading at a big discount to the acquisition multiples that others have paid, there could be opportunity there. And then there's also liquidation value. So if sometimes the assets are minus the liabilities are worth a lot more than the price they're going for in a publicly traded market. And so that can often spell opportunity as well. They can be rare, but you can find those as well. So those are the determinants of intrinsic value. So when we're looking at investing, we want to continue with the business approach to it. So what type of environment are we in? Okay, is this a bubble like 2000? Are assets trading at levels that are dramatically higher than they've been historically? What about interest rates? Is it a really low rate environment? Is it a high rate environment? Is the market cheap? Have we just incurred a bear market? Excuse me, and now stocks are trading at very low multiples. So you just want to have kind of a basic understanding of what we're in, so that you can prepare accordingly. Which asset classes or allocations provide the best risk reward given your goals and risk tolerance? So, if you're a retiree and if you're really, depending on your investment portfolio to generate income for your needs, and you're taking distributions regularly, having a lot of stock volatility risk is problematic, because the ebbs and flows of the stock market are very unpredictable. And if you're having to take regular distributions, you don't want to have to do so, at a time when the valuation of your portfolio goes down quite a bit. So when yields are higher, like they are now in 2023, you have really good options. I mean, you can invest in bonds, and even short-term government bonds are yielding 5%. Municipal bonds, you can get 5%, and then the after-tax rate is better than that. Corporate bonds, I mean, we're finding pretty good opportunities and pretty good credits that are yielding 8 to 11%. So there's a lot of opportunity there, but you just have to kind of be aware. I mean, 5 years ago, 3 years ago even, we could not buy bonds that were attractive. I mean, I think it was something like $15 trillion of negative yielding bonds. People were literally paying to loan money to governments or to companies. It was absurd. And now, we're in the opposite scenario where cost of capitals are going up dramatically. So, in those more challenging environments where it's a lower interest rates, creativity really helps. So covered calls, cash secured puts, those things that I've covered in some of the other videos that you can find on our channel, they can be very helpful in manufacturing income and reducing risk. Which individual securities and strategies can best position you to achieve these goals with the least level of risk? Once again, so just things. You want to actively manage your portfolio, that's fantastic. Often what we find is people are better served to be focusing on their occupation and their family, and then provide that to and have a professional serve them. But it can go either way. It just depends on the individual. And if outsourcing, who is the best option? So there are certainly, there's a case to be made for just ETF investing or index investing. There's nothing wrong with that. My only suggestion would be, be aware of valuations, because in 2000 to 2010 it was really a lost decade for stocks, and so index investing was not very popular then, because it was a terrible era for it. I mean, if you look at all the indexes and ETFs that loaded up at bonds at really low yields, I mean, I don't know that was the smartest strategy. They took huge losses there. So if you look at where valuations are now, as I put this out in late May of 2023, they're pretty stretched. So I think there's probably more opportunities in bonds than there are in the general indexes. So here's just like an example of kind of the treating your investment portfolio and treating your assets overall as a business. So interest rates had been historically low for the last decade plus before the Fed started raising rates aggressively in 2022. Business-like investors took advantage of the opportunity to procure long-term fixed rate financing when it was available. So this was a big recommendation that we made to our clients that we, took advantage of in our own lives is
you have this super cheap capital, and even if you don't necessarily need it, the ability to lock in long-term financing at those levels was too good to pass up for a lot of people. Those that did can now arbitrage the spread between the low risk fixed income investments and their mortgage rate. So if you're paying 3% on a mortgage, and a good portion of that interest is likely to be tax deductible, and you're making, let's just call it 5% or 5.5% in a bond portfolio, well, I mean, that spread is profit for you. There's tax consequences to the income, of course, but those are the types of business-like decisions that we're advocating for, and that we help clients work with and make. And then another one is credit cards. So the average interest rates on credit cards are now in excess of 20%, and debt levels are at a record. By prioritizing the elimination of those credit card debts, clients can potentially save tens of thousands of dollars in interest payments. This savings can go to creating and growing net worth through successful capital allocation and investing. I mean, Warren Buffett's become one of the richest guys in the world through compounding at around 20%. So that's the best guy out there. And so if you're paying 20% credit card debt, you're best off paying that off even before investing in any stocks or anything like that. If you're investing in your own business, that could be another story. Sometimes that's just how you have to do it. It's kind of bootstrapping. It's tough. I mean, it's tough to do it with credit card debt. I don't recommend it if you can avoid it. But I always recommend prioritizing paying off that credit card. It's totally fine to use the credit card and just pay it off monthly to get the points and stuff like that. But it really just becomes a huge weight and burden, and it's just very tough to grow your wealth when you're paying that type of interest. So that's just kind of a basic summary of how our learn to treat your investment portfolio as a business strategy kind of works. There's a lot more to it. The hand selection of individual stocks, the hand selection of individual bonds, all very important. In other videos on our channel, we talk about the covered calls and cash secured puts. One thing to be aware of is, and that a lot of people kind of forgot over the last decade, is interest rate risk. So, a 1% increase in interest rates typically results in about a 7% loss on the 10-year treasury bonds. That's the old rule of thumb. And so that's what you saw. That's why so many bond portfolios were down 15, 20% in 2022. And so, you want to factor these things in. So just because you're 70 doesn't mean that necessarily you should have 80% or 90% of your money in bonds. If bond yields are really low, like they were 3 years ago, that might not be the best scenario. Whereas right now in 2023, if you are interested in high yield or just getting a fixed rate return, I think the opportunities are a lot more plentiful. So that's going to conclude the presentation today. Please like and subscribe if you would like. That helps us out a lot. We're just starting this channel really, and we're looking to grow it. We've got some other videos that we've put out on covered calls and cash secured puts that I'd encourage you to check out. So thanks so much.